Welcome to the Broken Pie Chart Podcast, episode 233. I'm your host, Derek Moore. With me once again is my semi-permanent co-host, CEO of Zega Financial, Jay Pestrichelli. Jay, what's going on today?
Hey, Derek. Thanks for having me back. You know, I always look it up. 233 is a prime, just so you know. I know you're really curious about that.
That means what? The market's going up or down tomorrow?
Yep, you got it.
Okay, there you have it. Well, by the time this comes out, it will be the weekend. We're recording this on
It'll
a
be
Thursday.
up or down.
So, yeah, up or down. There you go. That was the old, wasn't there the movie Boiler Room where they would call people and recommend, like they'd call half the people and say, buy the stock, and then the other half sell the stock, and whatever worked out, they'd call that list back and say, hey, I gave you this one. I was right. Was that Boiler Room?
I mean, I'm not sure if they used that exact tactic in Boiler Room. It might have been the one, it's that movie that you watched that took place in Australia, like that you've mentioned in the past, and I can't remember that market movie. But I don't remember them exactly, breaking up the list, saying half buy, half sell. Interesting approach, I guess. You're always half right.
Yeah, you just keep going. Well, by the way, Boiler Room, why not make it a recommendation if you haven't? You'll see what...
Oh, yeah.
1990s. That's what Vin Diesel, Ben Affleck is in that. Got a lot of people. And so anyway, all right. So I want to talk about valuations. Liz Young over at SoFi put out an article. I'll link to it in the show notes. And it was titled Wrong Calls. And I think her point was too early or too wrong. And it was really, we've had a lot of things in the news recently about Wall Street strategists. Maybe some of them have been bearish or continue to be bearish when markets are going higher. But she put what I thought was a really nice chart in there, and it's S&P 500 forward valuations versus returns. So when we think about a forward valuation, we're saying, what is the S&P at? That's the price divided by the E, the estimates of the next 4 quarters, essentially. And in her graph, she pointed out that the forward 12 months, so forward 4-quarter PE, at the end of July, if I'm reading this, about 19.8. And obviously the audience can't see this, Jay, but it's a scatter plot. And what you take is the higher the PE, the higher chance for forward 10-year annualized returns to be lower. Am I quantifying that right, Jay?
Yeah, so what this is telling us, based off of the forward piece, so the earnings over the next year, what is the average return over the market over the next 10 years? Right? This is a long time based on this one little data point, right? So I listen, the chart is, if anybody can ever see it, is actually a nice, linear scatter plot, but it's a long projection based off of a very, kind of specific point in time of something that's uncertain. But why don't you, before I bash the chart, I guess which side of this discussion I'm going to be on, right? But before we bash the chart, why don't you tell everybody I buried the lead. So it's terrible podcasting on my part. I couldn't help myself. So why don't you tell everybody what at this 19.8 forward PE number, the average implied 10-year return would be?
Yeah, so annualized about 3.6%.
3.6%. So based on other times when this has occurred, that there was a 19.8 forward price to earnings ratio, the average per year over the next 10 years was only 3.6%.
That's right. But I think I like the chart, and here's why. There's really 2 things that can happen. The market could come down, and we have the analyst expectations sort of stay constant. The analyst expectations could get worse, and the market could stay the same, and the PE would go up, or earnings could go up. But I will say, this sort of makes the case for having a broad strategy of owning the market and being hedged, because if this is the implied 3.6, we know that over time, historically, we don't know what's going to happen in the future, markets have done pretty well. There's only been really 2 lost decades where the market was flat. So what this tells me is that maybe there'll be, let's say it's not earnings coming up. There might be a pullback, and that's why you need hedges. Um, but I will also say, Jay, that earnings estimates have been going up a little bit. And I want to give you some numbers, Jay, and then we'll kind of talk through it. I ran some of my own metrics. You can take these for what it's worth. And what I did was I looked at the quarterly estimates starting in Q3. So we're pretty much done with Q2. And we closed today, when I did this, it was like 44.75 on the S&P. So the next 4 quarters, if I add those up, the estimates, on a per share basis, it's $230.84. That implies about a 19.38 forward PE ratio. Okay. But what if earnings increase or earnings estimates are risen by analysts just 5%? Well, then you go to 242.38 and your PE comes down to about 18 and a half. But what if they go up 10%? And this is the last one I'll do. Well, then your next 4 quarters will be 253.93 and change. And then the PE is only 17.6. I mean, JP Morgan's Guide to the Market says the 25-year average of forward PEs is about 16.8. So I think it's one of those things. I think Liz has it right. Something has to give, but it doesn't necessarily have to be the markets coming down. It could be earnings going up, Jay.
All right, I'm going to unpack that a little bit. So first off, all of this is based off of kind of forward estimates, right? And you could have an estimate change. That's why it's called an
Yes.
estimate, right?
Yes.
And if right now we are underestimating what actually happens, Liz's chart, in my opinion, is a little fakakta. Like 10 years, I'm going to project based on what happened in the month of July of 2023, which is when we got a bunch of earnings. It seems like it just seems to me like there's not a lot of stock to put into this kind of a data point where one small, little change that could happen in 1 month can impact 10 years of projected market returns. So I don't know. There's just way too many things that can happen to push that number around. Like you said, of all of a sudden, we are underestimating what the earnings actually are, right? We may look back and say like, hey, back on August 10th, 2023, when we did episode number 233, the forward PE was, 19.8, but it turned out to really just be 17 and a half. So all of that stuff that the market is only going to go up 3.6% per year over the next 10 years is completely wrong. I don't know. I look at it's math and there's data here, but to me, it feels like, way too much is riding on things that are very uncertain.
Well, you mentioned uncertainty, and analysts are wrong all the time. Just look at the S&P targets at for the last 2 years have been totally wrong, probably except for Tom Lee. I think Tom Lee was the one we see on CNBC who probably got it right. He was the most bullish, but yeah.
Everybody gets this wrong, right? So I guess that's my point, right? So to base all of this math and this wonderfully pretty scatter chart based on, projections that don't have a particularly high level of accuracy seems like, pretty but not useful.
There is
negative on this one, huh? Really not giving in. Sorry.
Yeah, I'm usually the negative one. I'm being positive today. I like the chart. I think look, I'm going to put it in the show notes and people can go to it. But it also, I think it backs up what we always say, though. And I'll say it again. I mean, you just be hedged.
Yes, of course.
Yeah. I mean, if the analysts are undervaluing the next 4 quarters corporate earnings, then the markets are actually, maybe they're undervalued now. We don't really talk too much about individual stocks, but I can tell you back in, take 15 years ago, Amazon, people said, the PE is 8,000. I actually don't remember what it was, but the good as guess of any, right? But they grew into their valuation, like their earnings went up and up and up. And back, if you would have bought it 15 years ago, you probably bought it at, 1/2 times forward 15-year earnings, if that even makes sense. But the one thing I will say about earnings, if the analysts are correct, and you look at, Q2 is going to be down year over year, Q3 is projected to be slightly negative year over year, but then Q4, Q1, 2, 3, 4, 8, 7, and then you get double-digit growth year over year projected. Again, as you said, they're just projections. But this feels like the analysts are saying the trough is in, Jay, right?
Yep, I do believe. I mean, look at the data; it seems to point to that as well of actually what's happening. So, yeah, I mean, we're not done with earnings yet, right? So I guess we'll see when it all gets kind of summed up. But that seems to be the feeling, and the market seems to feel that way as well. And I always feel this kind of backwards looking stuff, and yeah, market's going to be ahead of it. Typically, the market's going to be ahead of it.
One of the things, this one's a tough one to explain to, verbally to an audience, but I think there's FactSet, I believe, data here. And what they're showing is the title of the chart is Forward Earnings Expectations Jump, S&P over the next 12 months, earnings per share. This one's a little funky, though, because it's like if you show a chart and you have a date that was a year ago, that was for the next 4 quarters a year ago. So actually, they've already happened. But at any rate, it does show the chart that forward earnings estimates are rising. And whether they're right or wrong, I'll let you know in a year. How's that, Jay?
Yeah. So the guess of the guess is going up.
The guess of the guess, correct.
Yeah. Yeah. Great.
I will say that it looked like it troughed right January and February. So, the market's smarter than everybody. The market knew they were going to raise their guesses, right? So that's just what it does, right?
I think it's also worth noting we're not back to the guess of June 2022, right?
Right.
So what was happening in June of 2022, Derek? Do you remember what the market was doing? It was getting hammered.
I think it was going down, and that meant the analysts still had to lower their estimates more, right?
Yeah, and then so great job, analyst.
All right. Yay for analyst.
Well,
The other thing I wanted to point out is you and I watch the high yield markets. We watch the corporate bond markets, investment grade. And I want to ask you about volatility, but volatility and high yield spreads are kind of related a little bit. Now, high yield spread, what that means is for everyone listening, it's the spread of holding high yield bonds minus holding treasuries. And so there's different ways that can go up or down. High yield bonds can sell off, and when bonds go down, yields go up, and that can expand. That's typically what we see in a really bad sell off, like we saw in early 2020, 2008, those types of things. Jay, recently they've been trending down. I mean, they popped up a little bit last few days. This kind of surprised me. Maybe I just haven't looked at this in a while, but the bond market is not showing a lot of fear. Either that or treasury yields have risen so much that it's narrowed, right?
yeah, and the reason why you made the connection here between this and volatility, it's kind of a reflection of risk appetite, right? And so when people that are looking to buy bonds, right, when they're willing to pay more for those bonds, right, that ends up pushing the yield lower, which says, oh, look, I'm only get a little less payment because I want this bond so much, and that will push the price up and the yield lower. So generally, as the yield is dropping, it's seen as a safer investment. But then you're right, Derek, on this point of spreads versus treasuries. What if the treasury moves and the high yield stays the same? We talked a lot about this through most of definitely the early part of 2022, the latter part of 2021, because these yields were the spreads were coming down, right? And a lot of it was because now you've got rising rates coming out of the treasury, and the difference between the high yield rate and the treasury rate was narrowing. A lot of that was because the Fed was raising rates and treasuries were on the rise, not because all of a sudden everybody had more of a high yield appetite. So you're right. You have to understand the factors that impact the spread. But generally speaking, the spread itself here, the spread between those two vehicles, high yield and treasuries, is the indicator of, it can be considered a fear indicator or lack of confidence in the debt market.
I will say, I mean, we're only down. What do we calculated about 3% off the most recent 52-week high in the markets. But Jay, volatility, although it is higher than it was, I think we had a 12 handle, high 12s for a while. Let's say on something like the VIX Index today, a little bit south of 16. VIX is not volatility has not necessarily spiked, and maybe it's because it's a little bit of an orderly, slow, just retracement. I mean, like I said, it's only 3%, Jay, but I don't think volatility is really showing too much fear right now.
Nope. We're still, like you said, I think we closed today with a 1585. We did see as high a few days ago as like it touched on 18 and pulled back. You and I have always talked about, under the 20 range seems to be interesting. We have data that tells us 21 is an interesting level on the VIX. The other, so yeah, I think we're still in this kind of lower regime, even though we seem to be a little, higher than we were a month or two ago when it comes to the VIX. The other thing to watch for is the options on the VIX themselves, right? What is the speculation of where the VIX is going to go? The index we use for that is the VVIX. That has been ticking up as well. And again, it's the how much people are willing to speculate on the change of the VIX itself. So it's kind of a derivative of a derivative that we use here to watch this. That has been kind of steadily on the rise, but really, I mean, relatively flat. But it is kind of we're at the higher end of the range there too. So I think we'll probably see before there's any real speculation to the downside of them in the market, I think we'll start to see that reflected in the VIX. And it's usually kind of a cheap bet. It's the first cheap bet that people make on maybe I could get a quick pop in the VIX and get some, easy money while the market is still in a slow decline before anything gets really nasty. But Derek, I would still say we're in this fairly low volatility regime, but edging higher. Edging higher is the way I'd put it. Nothing, screaming that you should be running for the hills here, and certainly nothing saying you should be, buying the dip. Like that's the other side of this, right? A lot of people will use the VIX as kind of a contrarian indicator as when they should, be buying a dip. Doesn't say you should be buying a dip yet either, right? It's really more of neutral at this point on the way to the way I would interpret it, right? The VIX isn't giving us any real direction, but it isn't telling us all is everything is awesome, like the Lego movie says.
Oh, is that a recommendation, Jay? Lego movie.
I mean, who doesn't love the Lego movie?
I
Lego
do
movie's
remember
great.
seeing that with my son, and a lot of kids in that movie theater, and they're just screaming that song. Everything is awesome,
Yeah.
and yeah, that
Where's my
was
pants?
yeah, exactly. So
Yeah.
if you have kids, that's always a good one. All right, Jay, I agree. I mean, we're a little bit. I don't want to say no man's land, but it's higher than it's been, but it's not acting crazy. I do think that sometimes when we see the VVIX rise, it reflects a little bit of skewness or in the markets. And put another way, it's you're not going to get away with a really cheap purchase of VIX calls or puts, but calls as they're yeah. I mean, you're paying up a little bit for stuff on the VIX, but
You're gonna pay up. Yeah, there's a little premium on the VIX calls right now, on the VIX options. Yep.
I didn't have time to do anything with this observation today, so I have no data on this, but just an observation I'll bring up, see what your thoughts are. Just the ranges that we've been seeing between the highs and lows in the market. Today we had a pretty high range. I feel like this last week we've seen markets start one direction, go another. I don't know. I mean, if you have any thoughts on that, if that's
I do. Yeah, no, for sure. And even like you get days like, oh, we finished flat for the day, or maybe up 1 point. Today's a good example, right? The S&P was up 1.1 points, not percent, 1.1 points. but it felt fairly bearish because at one point, we were 60 points higher than where we finished the day. This is there's a data point, Derek, that you introduced me to, the is it ATR, average true range, right? So it kind of starts to tell you, this is a technical analysis study, that when the market is wide, regardless of where it finishes, it matters that you've got kind of a wide range within the market. And market goes up, market goes down, finishes flat, but every once in a while it starts to tell you that one side of that equation could not show up one day, right? So today started out pretty strong. If the bears didn't show up, it felt like it was going to be a rocket of a day. It turned out not to be, because we proceeded to sell off from 10 a.m. Eastern time all the way through to like 2 or 2:30. So it's this range, the width of that range, longer bars insinuate more volatility, and the bars are getting a little longer. The candles are getting a little longer on the chart. That You're right. That is something that can be interesting. I think maybe you bring up the daily range metric at some point in the future on a future podcast.
Yeah, I can maybe run some. There's something there. It's just
Yeah,
we've been
that's an old
sort
favorite
of in
of
a.
yours, right?
Oh, it is. It is.
Yeah,
That goes
yeah.
back to the turtle traders too. Michael Koval wrote what was it called? Complete Turtle Trader. I have it somewhere. I remember interviewing Michael on the Market Huddle back in the TD Ameritrade days. Which, by the way, if anyone's interested in trading, the Turtle Traders is a fascinating story where they take Richard Dennis and Bill Eckhart. This is in the 80s in Chicago. They put a want ad in the paper, and they basically wanted to hire traders who had no trading experience. And there was a bet between these two men that said, are great traders, do they just have it? Or could you teach them a system? And so Complete Turtle, Michael Koval wrote it. I think it's called Complete Turtle Trader.
Sounds like
But it's kind
Trading
of an
Places,
interesting.
by the
Yeah, well, there's argument about which came first. That's
way.
there's some arguments about that.
Yeah.
But yeah, so anyway, it's an interesting story. And of those people that got hired, I think it's Jerry Parker, and I mean, some of them are managing billions of dollars today. They're still, and it's trend trading, all that stuff. But we completely got off track. Oh yeah, I know why I got off track. Thanks for getting me back on track. The ATR. Yeah, that was how they sized one of the ways they sized their positions in futures markets. So there you go. All sorts of recommendations were dropping along the way, Jay, today.
Wow, it wasn't ATR part of the D-Rock indicator, your proprietary signal.
It is. It is.
Yeah,
Still is.
yeah, something.
Yeah.
All right, there you go. A
So
little inside baseball for Derek.
there you go. All right. So let me get to a couple other things here. There's a site called Econ PI. I will put a link to that in the show notes. But if you Google Econ PI, what they do is they have they call it a median of coordinates, and so they separate these things into a grid. And the upper left is the decline quad. Then you have the expansion quad, recovery, and contraction. And you've got all sorts of things like non-financial profits, yield curve spread, hires, job openings, vehicle sales, all sorts of stuff. So when you look at this, and you can go to the site, and you can go left and right to go forward or back, you sort of see over time like what things are in decline, which ones are in expansion. And I just happened to check in on this the other day, and there is stuff, pretty fair amount of stuff in either contraction or decline quad. The other thing they do is they track this sort of median of coordinates over time. It looks like if you ever watch the Weather Channel, and you see when there's a hurricane, there's the line that plots the path of the hurricane, and this will go back and forth. But yeah, I just thought this was interesting because their chart here starts in Q1 of 20, and you see it was in contraction, goes to recovery, goes to expansion. And then it's, in 22, it went back and forth between decline and expansion. It's in decline right now. It doesn't mean it can't go to the other way, but I don't know, just the path of this. And I don't know if it tells us anything on a forward looking basis. If maybe this was the trough, what we've just been through in the economy. Again, I'll know when I know, but any thoughts on this, Jay?
Yeah, I mean, this is an interesting data look at all of these different, data points, and I like that they kind of combine them all to say, look, out of all this information that's out there, we'll put them all together and find the median, and then here you go, boom, we're moving from the contraction quadrant to the declining quadrant or the expansion quadrant. It seems to me it's more right closer. I know we're in the declining quadrant, Derek, but it's not by very much. It almost feels like it's smack dab in the middle of the whole thing, right? Like, you know, zero on zero on this grid. Like it almost tell it's you couldn't have actually picked to me, besides this week and last week, like a more neutral time to look at this. I'm not sure it tells us anything either, but I think the way that they combine all of their information is tells me that we're kind of neutral. What I would think would be interesting, Derek, is on each one of these points, if then like the next, I don't know, 3 months of the market was plotted right next to it. Like after, the last time that we were in the expansion quad, here's what the market did, right? The last time we were over here, that would be a little useful for all of this because they don't really do any for, here's what happens when you've had these states before. So I don't think it's a bad way to look at this. I'm scrolling back through this, right through. I think the data goes all the way back to 2020, right?
Oh, it goes back to before 2008. If you keep hitting the button, keep going.
Oh, just more button. Okay, got it. So,
Yeah,
yeah,
yeah.
yeah. Look. I don't think there's too much to take. I think it says the data is that's out there that we get, all the fundamental data that we get every morning, isn't really giving us an aggregate. Isn't telling us one thing or another.
All right, fair enough. It's an interesting chart. I'll put it in the show notes. People can check it out if they want. But it's the thing with economics also is there's so much of this stuff that some of it's early, some of it's late. Like take employment, Jay. Unemployment rate is one of those things, and Michael Cantro, we talked about his hope is what is it? Housing, orders, profits, and then employment. Meaning employment is the last thing to go if it's going to go. And typically when it goes, it just goes. And you're already sort of when unemployment's going up, you're already in the recession. Like it's the last thing. Our friend Nathan had sent us over something, and it was taking a look. So I recreated the data, a chart of the unemployment rate, and I went back to I guess this is the very end of 1999, and then I threw on here a 12-month moving average line. And one of the suggestions was when the unemployment rate line crosses over and goes above the moving average line, that's when you're going to have a recession. There was some talk about, in I think it was June, it went above. Now July, it's back below. We're sort of sideways right now. I don't know. I mean, to me, when this thing goes, it's too late. Like to me, it's not really telling us too much. But I don't know. What do you think?
Well, I think unemployment. I think we got it last week, right? Starting to show some cracks in the in the labor market. You're right. I think it's also there's a little bit of you know relative comparison when it comes to this data because yes, you may you have this very low unemployment rate, and you have this tight line between what that rate looks like and its average. I don't get a whole heck of a lot out of this data either, because everything's kind of been fairly stable. Okay, we may be coming towards the end of, well, summer is, we're in the middle of summer, but like September comes, we could probably start to see some of the effects of the cycle that we're in. And we've got some people on our investment committee who think that we will start to see the impact of higher yields in the construction market in start to make its way into the economy come the fall, I don't know. Like, I'm not sure how deep that's going to go. Um, it seems like everywhere I look, there are plenty of jobs open, right, for people that are looking for work. Job openings doesn't seem to be a problem, and so I I understand why somebody would want to say, look, when things move against their average or cross against the average, it's the time to assess that there's a turn. But when I look at the data, Derek, it's been flat. All it means is the average is coming down to right where the numbers are. So I don't think this data is particularly interesting. Hey, that's the third thing, Derek, that I'm telling you isn't particularly interesting today. So I'm not. Maybe I'm.
Yeah. Well, hopefully the rest of them I hit a winner. I will say on this though, some of this is math, and the unemployment rate only includes those people who have a job and the people who don't have a job but are actively looking. This is survey data. They extrapolate out. They call people, and I don't know who the heck is answering the phone from the Bureau of the Bureau of Labor Statistics. I don't know if they call cell phones or not, but anyway, that's neither here nor there. But they call and say, "Do you have a job?" "Yeah, I have a job." "Okay, great." "Do you have a job?" "No, I don't have a job." "Are you looking?" "No, I haven't looked in like 2 months or 3 months." Okay, those people are out of the data. There's different metrics that measure, discouraged workers and long-term unemployed. So you could have a change in the number of people who are working, the number of people who are out of work and looking, or the number of people who have just given up. So let's say everyone who's looking for work just gave up, we wouldn't have any unemployment, if that makes any sense. So I think recently there were some changes in some of the numbers, and I'm not saying like a nefarious thing or redo or recalculation, but part of the reason why the rate came down is I think the participation rate changed a little bit. So I don't know. I mean, to me, like unemployment goes at the end. And if you were like waiting for this to go, you're probably too late. It's the whites of the eyes are already there, Jay. So there you have it.
If it's even ever going to happen, which maybe it already did behind us. It could be behind us. You don't know.
So I have also a theory because people also look at job openings, and with a lot of companies returning to work, here's my theory. I'm probably an idiot on this, so I don't know anything, but this is my theory, and I'm going to present it here. Why not? When you have work from home and you have a company that is listing jobs, like don't they have to list it in a lot of different markets? Like wouldn't they list it in New York and LA because people can be from anywhere? In other words, are they like double counting job openings? I don't know. Somebody can let me know how that works. But I wonder with
That's an
return to the
point,
office.
right?
Yeah,
Yeah, but I don't know. I mean, you just put work from home in the job opening, and there you go, right? I mean,
I
Sega
guess.
recently hired somebody, right? It was, while it was not a work from home role, but if it was, we would have left it out there, right? We would have had the recruiter go look and find that person wherever they were. That's not our case. We work out of an office here in Florida at Zega. By the way, Derek, in case you were wondering, we're in the office
Yes.
every day.
Yeah.
Uh,
That's good.
yeah, I mean, I'm going to say maybe, Derek. That is a newer phenomenon it'll be interesting. I mean, that's probably a whole different podcast about the whole work from home and the future of employment data and how it gets impacted. I think you bring up an interesting point. No one's really talked about that one.
I don't know anything. Yeah, this is all right. I just wrote it down, Jay. I'll find some nebulous data somewhere and I'll bring it. I will say that we got to talk about our friend Jerome Powell. Now, people may notice that we did not talk about CPI nor inflation. I will have to mention in this next thing we're going to look at, but we're not talking about inflation. What I am talking about, Jay, is you and I have said for as long as anyone has listened to us, the Fed raising rates did not lower inflation. And the reason why we say that is because we had supply chain issues, and then the federal government threw a bunch of money into the economy at the very point when you couldn't get stuff. Jay, this chart shows the global supply. Who is this from, by the way? This is New York Fed and macro policy perspectives. There you go. So one line that I'm looking at is the global supply chain pressure index. Don't know what that is. I assume it means how much pressure is on supply chains, and it makes sense because if you could see the shape of the chart, 2020, it went way up in 2021. And then it corresponds with the U.S. Consumer Price Index, the core goods year over year, lag 3 months. And what I see is when there's pressure on supply chains, the CPI tends to go higher, supply and demand. Jay, we were right all along, and this proves it. This is the evidence I have.
Hey, I like this one, Derek.
All
Can I say I
right.
like this data point that you provided today? Listen, if I was to take the other side of that argument, you could say, well, supply supply chain pressure eased because the Fed adopted a restrictive policy and people decided not to spend as much, which, by the way, we know is not the case, right? Consumer spending continues to be strong. So, I took the other side and then immediately beat down the other side. So I'm with you, right? It was always a supply chain problem with inflation. I think we've always talked about that. So if that is now finally easing, which certainly seems that supply chain pressure is easing, it should bring down inflation, not necessarily what the Fed is doing. You think which political figure will take credit for easing the supply chain pressure, Derek?
Oh, that's
Any
the
guess?
easiest answer ever. All of them.
All of them. They all made it better for us.
Yeah. Oh, of
Oh,
course
yeah.
they did. Every one of them. Yep. Thankfully, we have politicians, maybe.
Yes. Yes. What would we do?
Yeah, no, we're sort of beating a dead horse on this one, but it, you know, you and I always say stuff means something when it means something. And my example is always Greece and debt to GDP. It meant everyone was all up in arms or freaking out because Greece's GDP was X percent. It's higher today than it was a decade ago when they were doing live CNBC remote spots from Athens and showing the pantheons in the back. But
They shut down ATMs, right? Like you could only take like 60 euros out a day. Do you remember that? It was like pandemonium in Greece.
now it doesn't matter. European markets have done well. In fact, I didn't bring a chart, but Europe or foreign markets only by a tiny bit. But for the first time in a while, they are outperforming US markets. But I think it's only like 4 or 5 months old. I didn't have the chart though. But for a long time, US markets outperformed foreign markets. So we'll see what happens there. All right, Jay. Anything else on that? We want to go to
Nothing else on that.
recommendations.
Congratulations being correct, Derek.
Yep, you too. Congratulations on being
Yes.
correct. We
Thank
knew
you.
we were right, and this proves it. Jay, any recommendations this week?
I have it queued up, and I will watch it. The second half of the Lincoln Lawyer on Netflix. So season 2 came out. Netflix is starting to do this thing where they usually release the whole series. In the past, they released the whole series in one shot. Now they're starting to break it up a little bit. I don't know if that's a little play on what every other streaming service does, where they kind of release one episode a week. Netflix was always the whole thing. Anyway, The Lincoln Lawyer, the second half of the second season is now out, so I will be watching that one. Still watching Justified, still enjoying that I mentioned last time we were on.
Yeah, I had some people ask me if you can just go into that new season because I guess it's different, but I don't know. You went back, right?
I accidentally did it, and I was like, whoa, wait a minute. I think there's the whole, they gave it a little different title. So, because I think it was a couple years off that they took, 6 years off or something like that, 5 years. So, still worth it going back to the beginning. Same for the beginning. Yep.
I saw a chart. I didn't put it in our show notes, but I saw a chart that basically the cost for all these streaming service just keeps going up and up and up. And at some point, I think it's going to be problematic. Like, what do you drop? Do you need all these Paramount Plus? You need Hulu. You need Disney. I guess with Disney, it's you have to have all three, right? ESPN, but Maybe that's a good indication of the economy or something like that. I don't know.
Yeah, they keep going up. Well, listen, I'm worried we're going to run out of content, right? Are we still on strike? Actors still on strike? Actors and writers?
They are, and I think, yeah, we're going to wind up with a bunch of reality shows. But I feel like they've stored up a lot of content, so we'll see. And there's plenty of stuff to watch that I haven't gotten to. I had a audience listener, Michael, our friend. He gave me a pick that's on Hulu, and I can't find my notes, so I may have to save it for next week. It's with Samuel Jackson is in it. It's about people. Yeah, I'm going to talk about the show. I don't even know the name of it. I can't find it. I haven't watched it.
This is helpful for everybody.
Yeah, I'll explain it next week, Jay. So, all right. I don't think I Boiler Room. That's my recommendation. I haven't watched anything recently.
And congratulations on your Barbie breaking. I think $1 billion.
It's not my Barbie.
That was not yours. Okay,
it's not my movie. No, I have not seen that, and I don't know if I'll see that. Maybe I think I'll wait for cable for that one.
Okay. Yeah.
Those of you in the New York City area will get this. I'll wait till that's on like WPIX channel 11 on like a Sunday afternoon movie. Only those in New York will get that.
Yeah, that's like at least 2 years.
Yeah, I'm looking forward to it. And I don't live there anymore, so maybe a challenge. Jay, thanks again for coming on. We'll come back next week and tell you how wrong we were on everything that we talked about this week. And until then, we'll see everybody soon. Take care.